Welcome back to the channel. Today we are going to talk about a topic that affects every single person in the economy, whether they invest in the stock market or not, and that is inflation. More specifically, we are going to understand what inflation is, how it is measured, and most importantly, how it affects the stock market. By the end of this video, you will have a clear understanding of one of the most important economic forces that drives market movements. Let us get started. Inflation is simply the rate at which the general price level of goods and services in an economy rises over time. In other words, inflation means that the same amount of money buys you less than it did before. If a cup of tea cost 10 rupees 5 years ago and costs 15 rupees today, that increase in price is a result of inflation. Inflation is a natural and normal part of any growing economy. A moderate level of inflation, typically around 2 to 4% per year, is actually considered healthy because it encourages spending and investment. When prices are rising gradually, people are motivated to spend and invest their money today rather than hold on to cash that will be worth less tomorrow. However, when inflation rises too quickly, it becomes a serious problem, eroding purchasing power, hurting savings, and creating economic instability. Section 2. How is inflation measured? In India, inflation is primarily measured using two indices. The first is the Consumer Price Index, also known as CPI. This measures the change in prices of a basket of goods and services commonly purchased by households, things like food, clothing, housing, transport, and healthcare. The CPI is the most widely watched inflation measure in India and is what the Reserve Bank of India, the RBI, monitors most closely when making monetary policy decisions. The second measure is the Wholesale Price Index, also known as WPI. This measures price changes at the wholesale level before goods reach the consumer. WPI is a leading indicator because price increases at the wholesale level eventually make their way to the consumer level. When you hear on the news that inflation has risen or fallen, they are almost always referring to the CPI number. Now, let us get to the most important part. How does inflation affect the stock market? The relationship between inflation and stock markets is complex, but here are the key things you need to understand. Moderate inflation is generally good for stocks. When the economy is growing at a healthy pace and inflation is moderate, companies earn more revenue, profits rise, and stock prices tend to go up. This is why stock markets generally perform well during periods of moderate economic growth. High inflation, however, is bad for stocks for several reasons. First, when inflation is high, the RBI raises interest rates to cool down the economy. Higher interest rates mean borrowing becomes more expensive for companies. Their profits and growth prospects. Higher interest rates also make fixed income investments like bonds and fixed deposits more attractive compared to stocks, causing investors to shift money away from stocks into these safer instruments. This shift reduces demand for stocks and pushes prices down. Second, high inflation erodes the real value of a company's future earnings. When analysts value a stock, they estimate its future earnings and discount them back to present value. When inflation is high, the discount rate used is higher, which reduces the present value of future earnings and therefore reduces the fair value of the stock. Not all sectors of the stock market are equally affected by inflation. Some sectors actually benefit from inflation while others suffer significantly. Sectors that tend to do well during high inflation include commodities. Companies that produce oil, metals, and agricultural products benefit because the prices of these commodities rise with inflation. Real estate companies also tend to do well because property prices generally rise with inflation. Banking and financial sector companies can also benefit because higher interest rates improve their lending margins. Sectors that tend to suffer during high inflation include technology companies because their valuations are based on future earnings which get compressed when interest rates rise. Consumer discretionary companies, those selling non-essential goods, also suffer because consumers cut back on spending when their purchasing power is eroded by inflation. To summarize, inflation is the rate at which prices rise over time. In India, it is measured primarily through the CPI and WPI. Moderate inflation is healthy for the stock market, while high inflation is generally negative because it leads to higher interest rates, reduced corporate profits, and a shift away from equities to fixed income investments. Different sectors are affected differently. Commodities and real estate tend to benefit, while technology and consumer discretionary tend to suffer. Understanding inflation and its relationship with the stock market gives you a significant advantage in understanding why markets move the way they do. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.